Good afternoon, everybody. This is Tim Devlin here with Life Pro Asset Management, and you'll notice a change in host this week from our portfolio manager, Robert Rayburn. Now, some of our longer term viewers may actually recognize me from earlier in the year where Rob and I did some of these weekly updates together and shared the hosting duties. But I figured it was about time that I took over the show, uh, took the spotlight away from Rob a little bit, and did a weekly update myself. Now, all joking aside, Rob actually asked me to do this weekly update to walk our viewers through the importance of having a plan so that when we're going through times of market weakness, we can actually use that to our advantage, use that as an opportunity. And so leads me to uh, the topic of our presentation today, investing with a plan. Now, 2021 has really proven the importance of having a plan because those disciplined investors have been able to see through some of the noise that we've seen throughout the year, throughout the summer, and have been able to position themselves for the years to come. And so there's a couple things I want to focus on today in this presentation. The first is what have been the most common investing mistakes that we've seen in 2021 in particular, but throughout our time here. One, market timing. That's always one of the biggest mistakes that we see trying to time the market. The second is panicking during market drawdowns. So we'll go through this. The second is we're going to talk about some of the short-term effects, but I'll pose this question. Will short-term events affect your long-term plan to reach your goals? And so with this question, what we need to do is focus on the fundamentals, focus on the data and the balance of evidence, and let that guide our decision in conjunction with our plan. And then the last thing is talking about the importance of your advisor. Utilize your swing coach because they're there to not only help you stick to your plan, but to help you improve your plan. And so before we get into some of those common investing mistakes, what I want to talk about is what was your initial plan? Whenever I work with an advisor and one of their clients, the first thing I always ask is, what is your goal? What are you trying to achieve? The second thing I ask is, when is that goal set to occur? How far in the future is it set to occur? Because what we want to do is split up a client's estate into 3 different silos based on that time horizon. Over the short term, we don't want to take a lot of risk. We want to have a very low targeted growth rate because we don't want to put you in a position where there's market volatility, you need the money for a down payment, for college expenses, whatever it may be, and you have to lock in losses to no fault of your own. You just didn't have time to recover. So over the short term, we don't want to take any risk. Over the medium term, we want something with lower volatility. We want to have a targeted rate of return, something better than a cash account, better than a money market, but we don't want to put full market volatility into the portfolio because we want to manage those short-term expenses, those short-term spending needs. And then lastly, we set up silo 3. And this is really focused on long-term growth where we want to utilize volatility as an asset over the long term and try to grow the value of your estate. So as we go through this presentation, really we're focusing on this long-term growth, the silo 3. So keep that in mind. So the first common investing mistake that we see is panicking during market drawdowns. So I think what we have to do is put some market history in perspective when we're looking at this, because what you're seeing here on this chart is from 1980 to 2021 year to date, the S&P 500 has had plenty of intra-year drawdowns. Those are these red dots throughout the year. But what you'll notice is some years, 2020 is a great example, where we had a negative 34% intra-year drawdown, but we ended up still being positive on the year, 16%. And on average, an intra-year drawdown, the S&P 500 is about 14.3%. But over that time period, 31 of those 41 years ended up with a positive return at the end of the year. And so we want to use that historical perspective to view these not as a time to panic, but as an opportunity to buy assets when they're on sale. This is an opportunity zone for you. Because the worst thing that we want to try to time the market and go to cash, because there's a behavioral cost to that. Now, in this study, what happened was, or what the study had done is they looked at the S&P 500. Had you invested 2010 in the S&P 500 to 2020, and you're invested in all days, your initial $100,000 investment would have grown to $366,000. Now, had you missed the best 10 days, those best 10 return experiences, you would have only grown to 201,000. Had you missed the 20 best days, 141,000, and you can see 30 days and 40 days, you actually ended up with a negative return experience. And so the worst thing we can do is try to time the market. We don't want to go to cash lightly because there is a behavioral cost to that if we are wrong. And so with those two things in mind, let's take a look at the tactical opportunity strategy, because there was a great buy window this year. In August 2021, we saw a drawdown from some of the shorter term noise that we saw throughout the summer. And that resulted in an opportunity for investors to buy assets when they're on sale, when the fundamentals of the business were improving, but the prices were not reflecting that. And so we'll walk through that. But first, let's talk about some of the short-term noise. Now, a lot of the short-term noise can be attributed to COVID cases, Delta variant that came up during the summer and put a little bit of scare in the market, put a scare on growth expectations. But what we did was we focused on the data, the balance of evidence, and what we could see is, although the cases were increasing, we could see that rate of change starting to slow. And that case count actually peaked out in the beginning of August, in the middle of August, I should say. Now, coinciding with that rate of change slowing, those case counts peaking, you saw interest rates starting to bottom out and beginning to rise again. That's good for the economically sensitive areas of the market that we were positioned in. So what we want to do is not focus on the short-term noise. We want to look at the fundamentals of the businesses underneath the hood. And so let's talk about that a little, because throughout history, stocks, markets, they have a tendency to overshoot during times of optimism and then undershoot during times of pessimism, where the intrinsic value of the company, or in other words, the fundamental value of that company, doesn't align with the price that it's trading at. And when we go through times of pessimism that are led by shorter term noise that really aren't affecting the fundamentals of the business, we want to view that as an opportunity to buy assets where they're trading at a price that is underneath what we believe the intrinsic value of that company is, because that's your long-term window of opportunity. You're buying these assets on sale. And so let's talk about a prime example of that. Energy has been a prime example of that. And so what I want to do is go through a hypothetical oil producer company where the price of oil earlier this year, right near the beginning of the year, was trading at $50 a barrel. And so for this company, it may cost them $40 to produce this barrel of oil. And with that, they'll capture $10 profit. But what we saw underneath the hood is an increasing demand for energy, increasing demand for oil, and a lack of supply response that we believed would lead to an increase in the price of oil. Now, this wasn't reflected in the companies due to some of the shorter term events with the Delta variant, but what happened was that oil price started to increase. We saw that happening, even though it wasn't happening with businesses. So as oil has increased to $80 a barrel, that $40 cost to produce has remained the same. It costs them the same to produce that barrel of oil, but now they're receiving $40 of profit. So over that time period, oil increased 60%, going from $50 a barrel to $80 a barrel, but the producer's profit increased 300%, going from $10 a barrel to $40 a barrel in profit. And that just is a testament to the fundamentals of the underlying business, because as this oil price increased, the companies were making more money than they were several months prior when oil was trading lower. And so we know that those companies are making more money, right? And what we see with those companies is they're actually returning it to shareholders in the form of share buybacks, dividends, and paying off debt. They're creating shareholder value rather than trying to increase production. And so this is a great example where the fundamentals of the business were strengthening, but it was not being reflected due to some of the shorter term noise in the market that wasn't really affecting the underlying business. And so this is really a testament to where we all need a swing coach. We need somebody to lean on where times of distress, times during drawdowns, we can lean on and say, hey, what should we do during this time period? And so earlier this year, there was a study that came out where they surveyed investors and then they surveyed advisors, and they asked investors, which of the following actions have you taken in the past 12 months with your portfolio? They asked a very similar question to the advisor. Which of the following actions have you recommended to clients in the past 12 months? And the interesting thing to see is that investors increased their equity position in their portfolio or their stock position by 31%, whereas the advisor had recommended to clients 63% of the time to increase that stock exposure. And so I think this is a testament to your advisor really being that swing coach for you when you're not really sure what to do. There's that short-term noise in the market and you're uncomfortable. You need to lean on that advisor and seek their guidance to help you stick to your plan and try to improve your plan. And so that brings us kind of full circle here is, what was your initial plan? Now, did you follow that plan or did you improve that plan? If you were focused on this silo 3, that long-term growth focus, we want to utilize volatility as an asset. So we want to buy great businesses when they're on sale. Did you do that? Were you able to take advantage of that opportunity? And if you didn't, let's take this into account. Let's keep this in mind going forward, because there will be more drawdowns in the future in the market. And we want to use those to our advantage. So in summary, I really want to close this out by saying, more than anything, focus on your long-term plan. And then lean on your advisor during those difficult times. We want to avoid those common mistakes in the market. Don't try to time the market by going to cash, and try to look at drawdowns in the market as a buying opportunity, not as a time to panic. Second, stick to the fundamentals. If the fundamentals are improving, stay disciplined. At some point, the share price will reflect that in the fundamentals increasing. And then lastly, lean on your advisor. If you haven't done so, reach out to your advisor, have them review your plan. If things have changed in your life, do a review. Maybe you want to buy assets when they're on sale. And lastly, lean on your advisor. They're there to help you make those difficult decisions during times of distress and really help you improve your overall plan. So with that, if you have any questions, please reach out to your advisor. They're there to help you. And with that, I want to say thank you for your time viewing this video today. Thank you for your business. We're greatly appreciative of it. And I hope you have a great rest of your week and a great weekend. Thank you.